We're seeing a far from festive approach taken by financial markets at the moment, and people are wondering whether the Santa rally is cancelled for 2024. Certainly, given the fact that we have a relative dearth of notable data points over the coming week, I thought it's worthwhile really picking through what's driving markets at the moment and whether people are going to be looking to buy the dip in some of the markets or whether we're going to see further downside. So this time around, we're going to be looking into the likes of the S&P, the likes of gold, and the likes of the US dollar as we try to gauge the shape of things towards the end of the year, rolling into the new year. Now, I don't have a huge amount to go on this time around in terms of slides. Nonetheless, there's still stuff to talk about. And certainly that's highlighted here by the fact that we have still got a few points, the likes of the Canadian GDP numbers on Monday, the 23rd. We've got the BOJ minutes. We've got the minutes from the RBA. We've got core durable goods on Tuesday as well from the US. And then we've got jobless claims and some data coming out of Japan. But as much as some of these releases might cause a little bit of volatility, the real volatility is already right in front of us. And we're seeing US equity markets really driving down global equity markets. This all comes off the back of that Federal Reserve meeting. And certainly things haven't really improved from there because we're now looking down the barrel at a potential US government shutdown. An agreement has to be reached by the end of Friday the 20th, which is when I'm recording this. So by the time you watch this, you will have seen that they either manage to get one across the line or they don't. So that's just something to pile on at a time when already markets are really feeling the pinch. Now, part of it comes down to inflation, and inflation is also being released today. So you're going to likely see that before you watch this video as well, with the core PCE price index being released. But what we can see here, and this is one of the charts that we always go through when we're looking at inflation over in the US, is this breakdown in terms of core inflation, be it the CPI, which is the blue line, or the core PCE. So it's core CPI, core PCE, which is orange. And what we can see here is that over recent months, we've seen a significant uptick in inflation pressures. It's highlighted by the 5-month annualized figure that we've got along the bottom. And we've seen this surge in terms of price pressures. It's really allowed the Federal Reserve to take their foot off the gas when it comes to monetary easing. Not that they're necessarily desperate to do so, but certainly the Federal Reserve this week essentially highlighted a move to just 2 rate cuts over the course of 2025. Markets are actually pricing more like 1. And so there's a distinct lack of confidence in the direction of travel. The fact that markets are pricing more like 1 rate cut and the Federal Reserve are outlining 2, what does that mean? That means that markets are thinking that we could very easily see a resurgence in inflation pressures, which further dampens the ability of the Federal Reserve to be able to cut rates in the year ahead. And that was really the backbone of many of the thesis behind, say, crypto strength and gold strength. And so we've seen some weakness in some of those markets. But we've also seen weakness, of course, in equity markets because one of the tailwinds behind equity markets is being removed, and that is looser monetary policy. Instead, interest rates are going to have to remain relatively elevated, and the hard work's having to be done by Donald Trump. Now comes the question of whether we trust Donald Trump to be able to do exactly that. And so certainly there's significant questions over whether his policies are good or bad. For instance, the tariffs policies, that could certainly benefit some companies, but it's going to come to the detriment of other companies and also could spike a surge in inflation. So it adds a lot of uncertainty. So if you take away the efforts of the Federal Reserve, which if they're cutting rates would undoubtedly be positive for US equities, would be positive for the US economy. If you take away those efforts and you leave it all down to Donald Trump, you start to see some jitters. You start to see some significant question marks coming into play. Core PCE, I'm hoping that we see a lower figure this time around. But if you look at those monthly figures over recent months, they're all around that 0.3% mark. Remember, we need to be below 0.2 if we're going to be heading back towards that 2% target. So inflationary pressures picking up over recent months, and there's fears that Donald Trump's policies might just exacerbate that problem. And that's why we're seeing, in one part, the weakness we're seeing in terms of equity markets, but also the strength we're seeing for the US dollar as well. This shows you the adjustment. This is not the headline CPI, so I should have changed that. This is the outlook for the December Fed meeting. So how are markets pricing the Fed funds rate for the end of next year? So 2025 rate cuts, how many are we expecting? Markets now pricing the base case scenario as 1, which would be 400 to 425, but that's just above 2, right? So you're getting 1 or 2 rate cuts over the course of the next year. And this is why we're seeing such strength for the US dollar, because whilst other central banks may be in a position where they can continue to cut, the Federal Reserve clearly has its hands tied and are moving away from those rate cuts. That has a knock-on implication for a number of things, notably the US dollar, because it's valued against other currencies, and therefore those other currencies are being driven by central banks that could happily cut rates by 100 basis points over the course of the next year. Now, another thing worth bearing in mind, that, like I said, that it might have been resolved or not in the coming 24 hours, is this government shutdown over in the US. Now, what's notable here is that last time we saw a government shutdown was the massive shutdown under Trump. And so, you know, he's got previous for this, but Trump isn't actually in power at the moment. Nonetheless, he had put something forward, it's been rejected. And part of that is because of the fact that Donald Trump is essentially putting forward a debt ceiling extension by 2 years or 4 years. And so he wants to kick the can down the road when it comes to cutting back on government expenditure. He wants to happily ramp up debt. And that is not what markets want to see, right? I mean, certainly when you're looking at the US 10-year yield, we've been seeing the yield on the rise, despite the fact that the Federal Reserve have been cutting rates. Part of that could come down to expectations of higher inflation and expectation of what's happening now in terms of the Fed not being able to cut rates by as much as we might have hoped. But also part of it is going to come down to the position of the US government and the Treasury when it comes to the bonds in the US. We're seeing the value of those bonds decline, the yields associated with them on the rise as debt rises. So the idea that Donald Trump wants to continue to push debt higher, that's likely to push yields higher. That's likely to push the overall debt higher once again, because the cost of borrowing on that debt continues to increase. And so markets would like to see that debt cut, but it's unlikely to happen under Trump. And certainly the resolution to this government shutdown question mark and the debt ceiling question, you know, it may not necessarily be positive, right? Because if they come to an agreement that kicks the can down the road and gives them, you know, an extension on the debt ceiling by a couple of years, what does that do to debt, right? And they're it's snowballing into an uncontrollable situation. And so, you know, how this resolves remains to be seen. But what's worthwhile bearing in mind is that we have seen a number of shutdowns in the past, and they don't always resolve with massive sell-offs, right? The idea of the government not being able to be funded, essentially, and certain parts of the government not being able to function, certainly isn't a good thing. But at the same time, markets in the past have taken it in their stride, and arguably it has formed a sort of sell the rumor by the fact situation. Now, I wanted to bring up the chart for the S&P 500 here and show you exactly where things were last time we saw that massive government shutdown. It lasted like a month under Donald Trump, and that was back here December 2018 into 2019. And you can see here, we did see a really sharp sell-off leading into it. And the government shutdown happened on this period here, and we then saw essentially the Christmas period coming into January. The agreement was found at the back end of January. And so what happened? Well, essentially it was that, right? I mean, once we saw markets open up to the news of a government shutdown, we did see another sharp move lower, but that marked the bottom. And from there on in, we saw people buying the dip and people seeing value in this market. So, are we going to see something similar this time around? Remains to be seen. But certainly, if we're looking at this as one of the sort of dual concerns within markets at the moment, we've also got to look out for the question mark of, where do the rates go over in the US, right? And the fact of the matter is, as things stand, we're pricing in less rate cuts, but we're seeing rate cuts around the world, right? So that would benefit the US dollar, but it doesn't necessarily mean that this is going to be the beginning of a massive crash for equity markets. So the whole buy the dip thing and potentially a Santa rally could still be on because we're pricing in less rate cuts. We're not pricing in rate hikes, right? And part of that comes because of the expectation that Donald Trump's going to come in with pro-growth policies, with policies that granted could be inflationary, could be. And bear in mind, last time that Donald Trump was in power and he started to enact these tariffs, we didn't actually see a major spike in terms of inflation. And if you're looking in terms of inflation, where's it coming from? It's not goods, right? It's services. Goods inflation is pretty much negligible. So if you see a bit of goods inflation, it may not be the end of the world. And you're seeing the likes of shelter costs coming down as well. So that could, help with the inflation picture because that's a very sort of slow moving, but a massive part of inflation over in the US. So, I don't necessarily think that we're in a position where we're suddenly going to see a massive spike in terms of inflation off the back of those tariffs from Donald Trump, but they're certainly providing some question marks. So, like I said, we're not seeing rate hikes, but we're seeing a cut in terms of the expectations of how many rate cuts we're going to see. But markets are now pricing essentially one rate cut. The Federal Reserve saying 2 rate cuts. And in actual fact, if we don't necessarily see inflation really sort of rear its head once again, maybe we see even more than that. So there's an argument that maybe we've got to the point where markets are now overly pessimistic and that things could come the other way. And certainly markets always seem to go too far in one direction or another. They were coming into this year expecting 7 rate cuts. Of course, seemed a little bit ridiculous then. Well, we're now expecting just the 1, despite the fact that the Fed are pointing towards 2, and would probably quite happily enact more than that if they're in a position to do so. So inflation data is going to be really key as we go forward. So let me just put this on a full screen and I'll just take you through a couple of these charts. So firstly, that's the S&P 500. That was the last shutdown. Let's see exactly where we are at the moment. I was just trying to get to it. Here we go. So pulling back in towards this 76.4 Fibonacci level, which is at, if we don't have it hidden here, 57.90, right? So 57.90 is the next big support level worth watching out for. Let's look at previous instances that we've seen pullbacks, because essentially this market always gets bought up, right? I don't think this is the top for the market. So are we going to see people buy the dip? Most likely, certainly if you look at previous instances, we'll likely see people buy the dip. Where does that dip buying happen? This is a moving average ribbon tool. So I don't, I used to put moving averages on my chart all the time. I don't necessarily anymore, but I know where I want to potentially utilize them and where I don't. This is an instance where I think a moving average might be quite useful as a potential sort of confirmation tool in terms of support. So this moving average ribbon's giving me the 20, 50, 100, 200, right? So what we've got here is the 50 here has provided some support here, but we've blasted past it. And so we can see here, we've got the 100 here, fan support here, and we also saw the 100 respected quite well here. So we know that the 100 could be an area that could provide support. Now that's coming in and closing in on that 76.4 in pretty much the same direction as where price is at the moment. Granted, price can move quicker than that moving average, but you can see that potential confluence of the 100 day SMA and the 76.4 fib. We're heading lower. So that looks like a really interesting area to be watching out for. Another thing we want to watch out for is momentum. And momentum can be summed up pretty well by some of these momentum indicators. You know, you can pick your favorite. It could be the RSI, the CCI, the stochastic. I've got the stochastic on here, and what we can see here is that generally we do see that breakdown within these moves into your sort of 100s and your 200s. We see that breakdown in through that oversold territory. Now, that doesn't necessarily in itself mean you buy it, right? Because if you see it right here, if we bought it, then it wouldn't be great because you continue to sell off for the best part of a week. Where would it be a good buying opportunity? Excuse me. I thought I'd muted it there. Where would it be a good buying opportunity? It'd be a good buying opportunity here, right? That is the absolute low, and the absolute low tallied up with the break back up through out of oversold territory. Let's look at other instances. So the sell-off is happening here. It continues to fall. The break up through oversold comes here, and that's the absolute low. On this occasion, you can see that the breakdown into oversold, we actually get consolidation, and then the break out of it provides that buy signal. And so now we look to where we are at the moment. We're in oversold. Does it mean that you buy it there? No, it does not. And we've seen continued selling off the back of that. Where are we going to buy it? Well, time will tell exactly how this plays out. Now, if it breaks up through that 20 threshold and we find support on the 76.4 fib and the 100-day SMA, that to me looks like the potential low for this market. Now, bear in mind, we can get this, right? You can get the chop. And that's very unfortunate because, you know, in these examples I've given you, the last 3 of the last 4 have all perfectly worked, you know, but these indicators, they're certainly not perfect. And you hope to find one that's very much clear. This occasion here, we got a lot of choppiness and we didn't necessarily see a clear move out of oversold and push upwards from there. So let's see exactly how it plays out. But certainly we've got the potential of 3 different things all playing into the same kind of area. If we see a move out of oversold, that would point towards momentum turning in favor of the bulls once again. Certainly a breakdown through 56.95 would be needed to negate the big uptrend that we've got at the moment and point towards a wider sell-off for the S&P 500. Then we've got the US dollar index. I've got the 10-year on here at the moment as well. And as you can see, it's tracking the 10-year very well. So if we think we're going to see higher inflation, if we think that Trump's going to be inflationary, you know, those are the kind of things that will likely drive the 10-year higher. We're starting to see it pull back a little bit here, but certainly if I pull up just the 10-year and it's on its own, this is the weekly time frame, you can see that we're sort of breaking out from this falling wedge formation. So there is a warning sign here that could provide further upside here and a continuation in the rise in borrowing costs and an extension to that debt ceiling and an ability to continue to borrow and borrow. You know, that could further push the 10-year higher. If we do so, as we see here, you've got the possibility of further upside for the US dollar. This is the dollar index. Now, if I get rid of the US 10-year and put in the US 2-year versus Euro 2-year, this essentially is a good reflection on the relative expectations around interest rates over the coming 2 years from the Eurozone versus the US. Of course, we're expecting to see the Eurozone be able to cut much more than the Federal Reserve. And that's what's providing the upside for this market. So another thing to be watching out for. Bear in mind, the dollar index, it is essentially very heavily weighted towards euro dollar. And that's why I'm using the US and the Euro 2 years. But you can see here this move higher. We've seen this consolidation recently, but now starting to push higher once again. And so we're seeing a similar kind of thing with that breakout for the US dollar index. So I think there's a good chance that we still do see further upside for the US dollar index and the US dollar as a whole. And certainly this looks like a big basing pattern that's been playing out here. Key to that is going to be inflation data. And we do, of course, have the core PCE price index coming out later on today. But what's happening in the US isn't guaranteed to be happening around the world, right? The Eurozone is in a difficult situation. You wouldn't say, you know, the Eurozone's economy looks so great, we're going to see a massive rebound in terms of price pressures. And so they just aren't in the same position as the US. And that could provide the basis for further upside for dollar index. And essentially that is being driven by further downside for euro dollar. And finally, I wanted to wrap it up by talking about gold. I know that gold is one of the favorites for our clients, and you can see here we have seen this sharp pullback. Now, from a long-term perspective, I remain bullish, and you can see here why, right? This is a trend that has been long lasting, right? Gold does perform well over the long term, and certainly at a period of time where we're seeing people really losing faith in US Treasury bonds, gold does hold its own. Nonetheless, of course, coming at a time where we're seeing dollar strength, that does weaken that story somewhat. And also part of the gold strength story comes off the back of the idea that we're going to see a raft of rate cuts from the Federal Reserve, and they're starting to be priced out as well. So that's why we're seeing some of the weakness that we're seeing at the moment. But we've come into this area with sort of trend line support at 76.4, which is at 25.82. So starting to have a little bit of tentative strength here for gold. Whether that lasts remains to be seen. And certainly if we were to break the 25.36, that would really be a major sort of warning sign that we're going to see a really significant pullback for this market. But like I said, a lot has already been priced in here. Markets are already pricing in just one rate cut next year, despite the fact that the Fed are pointing towards two. We don't know that Donald Trump's going to spark a big surge in terms of inflation. Certainly the idea that we are going to potentially see more borrowing is something that would give people cause for concern when it comes to the US dollar, when it comes to US treasuries, and that could be positive for gold. And globally, we are seeing rate cuts coming into play. So in an environment where the Federal Reserve is still expected to cut rates, gold's going to be a key one, but certainly we'll be very sensitive to what's happening in terms of inflation. Excuse me. I think I'm not the only person in London who's been getting ill recently. So yeah, this is a really interesting one. Certainly, we've been seeing this big pullback off the back of that Fed meeting, and off the back of that repricing towards less rate cuts. So keep an eye out for this one. 76.4 holding at the moment. Whether that's going to be the bottom, I don't necessarily. I'm not super convinced. Keep an eye out for resistance. If we break through the 26.26, that starts to tell a little bit more of a bullish story and starts to build something. 26.51, even more so. Thanks a lot, guys. I hope you have a really good festive period. And it's going to be quiet in terms of the economic calendar, but the fireworks are certainly going off at the moment. And it's likely we're going to have a pretty busy end of the year for financial markets.